Brown Show, where we talk about all things investing, options trading, and the like. Now here's your host, AJ, whose primary mission in life is to help you become a better investor.
All right, ladies and gentlemen, welcome to episode 157 of the AJ Brown Show. Today is November 8th. Good morning, AJ. We're through with the elections. Finally it's over.
Yeah, I don't have to worry about my mailbox being full or my phone ringing with people, text messages. I get a break. Although I have a feeling the next election cycle is going to start like in a month.
Yeah, no riots. A pretty clean sweep by the Republicans, with Donald and the Senate. And it seemed as if the market, even as the election was going on, was feeling really good in the after hours. And then the day after the election, I mean, I saw like 2.5% up across the board. Does that make sense to you? Do you see why investors are feeling positive about that?
Well, so I tell my users that about something called a transient external stochastic shock. Transient external stochastic shock. This is a short duration kind of news cycle. So that's the transient and the external. So it's not from, anything organic in the market, meaning buying and selling pressures that are normally present based on how well a company or a series of companies is doing. This was an external thing that happened that caused a shock. And when we say stochastic shock, it means that it's off the rails, right? That's what stochastic shock means, off the rails, because stochastics are measured in exponentials, not necessarily in linears. So if you have a stochastic shock, it's off the rails, right? So yeah, that presidential election was off the rails. We saw a ton of money flow into the markets, not just the equities market. I mean, the S&P, the Dow, it shot up through the roof. NASDAQ shot up through the roof, but so did bonds, right? Bonds shot up through the roof. But you know what? You saw a lot of people, not just mutual fund traders, although I think mutual fund, pension fund, hedge fund traders, especially hedge fund traders, started the ball rolling. They did some buying. And what did that do? People who were excited, right? And this election was a referendum, right? And there was, a majority. It wasn't even just, one of these things where an electoral college win. There was a big divide in the popular vote, which means people wanted this to happen. And so those people that wanted this to happen, their retail money, we see a huge chunk of retail money flowing into the markets the day after. What I think we're seeing now, Sip, and it's becoming pretty clear in the price patterns and in the VIX, is already only, 2 trading days after that big pop on Wednesday. We're seeing those mutual fund traders. They're very savvy, right? These big money investors, the ones who control the most of the market, the ones we've heard about when it came to, the whole GameStop things. These guys really are in charge. And it looks like based on the order flow. So, you can get an idea of what the heck is happening often by looking at how big the orders are, right? If it's an order that has a few shares, we attribute that to retail traders like me and my investing group and just the little guys out there. If it's these orders that, the number of shares is in the tens and hundreds of thousands, we attribute that to the mutual fund traders. So I'm seeing the mutual fund traders, market, pension fund traders, and especially those hedge fund traders, I'm seeing them starting to take their profits, right? They put the money in to get the ball rolling, to get basically hype it up. And then everybody, little guys, put their money in, and now they're taking their money out now that the price, that we're seeing us tapping on the S&P at that $6,000 level. I have a feeling there's a lot of people who have, limit orders at 6,000 for selling. I wouldn't be surprised, and we'll check back next Friday, but I wouldn't be surprised if the market corrects next week and comes right back down. We already saw the bonds. Bonds are already starting to sell off, and it hasn't even been 48 hours. So I almost feel like this transient, as this election gets in our rear view mirror, it's going to be, we'll probably correct to where we were.
And I sense as if there's a lot of assumptions being made in certain industries because of Trump being in office now, and that's playing into the market in general. But not only did we have that clean sweep of the election and the optimism from Trump, but the day after we had the rate cut, a 25 basis rate cut to add on top of the already optimistic news. And so
yeah, let's take a look at that, because that's really, we got this when it comes to economic news. And I've already said this for about a whole month now, for about the last 4 shows, that the Fed has brought us monetarily, based on the current, fiscal policies that have been in place, at least over the last year and a half. The Fed has brought us to this stasis point where, all of a sudden you read in their meeting minutes that they're having a lot of discussions, a lot of disagreements about what to do, which is good, in my opinion. It means that they've hit this balance point where, it's going to be little tweaks up, little tweaks down. They're controlling inflation. They're keeping the employment. But again, that's based on the current fiscal policy, the spending policy out of the U.S. government. That's going to change under Trump. And so what we saw on Thursday with the rate drop was a given, right? We knew that there was going to be a 1/4 point rate drop, a week before, when we looked at the probabilities, the CME Fed Watch tool, it was like 95%. It was a given that was going to happen. I do want to point something really interesting out, though, Cyprian, about the Fed. My mind is working so fast, I'm combining sentences. I can't, my mouth isn't working as fast as my mind. But this number, so this is December. This is the percentage that a rate drop of another 1/4 point's going to happen. And so it says 67.8 today. Yesterday it was at about 66.6. So it's been around the same number since the election has been over. But I have to point out that a week ago, this number was above 85%, right? And so it's these folks who are watching interest rates, watching the markets, they're definitely some smart folks, right? And the investors, I would say, are smart folks. I was watching, I don't know if you knew about this, Sip, but on the Robinhood, there were some options being sold on the election. And so I was watching as investors were investing in Kamala Harris versus Donald Trump options throughout the whole process. And it's very interesting. I know I'm on a tangent here. I'm talking a mile a minute. It's very interesting that those options expire on January 20th, because they were expecting, there was talk that, we were thinking, even with that weird Iowa poll that was like a week before, everybody thought that maybe the election would sway Kamala wise, and that then Donald Trump would create a whole mess of like legal issues, that it wouldn't be this crystal clear that it was a referendum on the Democrats and that it would go to the Republicans without any kind of contest. So the options went to the election because they figured there'd be all sorts of skirmishes, both in the courts and maybe even, January 6th, stuff like that. So the options don't expire until the president actually takes office. But, they were going Donald Trump weeks before the election. And now anybody who bought the Kamala Harris options are basically out of whatever their investment was. Coming on back to this interest rate thing, these guys are not, investors are not, they know what to do in the short duration, how to take advantage of a pop, like a transient external stochastic shock pop. But they also, I think, and I'm just interpreting the data as I see it, they know that some of the policies that Trump has been talking about actually would add to inflation and maybe have, Elon Musk even came out and said there's going to be some pain, at least for a short amount of time, that the Americans feel. So that means an employment, seeing an uptick in unemployment. And so this is, the Fed just worked so long to get this balance. The reason why we think that, investors are starting to believe that interest rates are not going to go down, in fact, they may go back up, is based on some of this rhetoric around his policies. Now, whether these policies get through a Congress is to be seen, because we don't even know which way. We know pretty much where the Senate is going to go, but we don't know yet. There's still a whole bunch of undecided races. We don't know who's going to be in charge of the House. So if it goes red, well, then, there's going to be a whole bunch of change, because now there's a sweep in the U.S. government. So fiscal policy is going to go in a certain way, right? There's going to be big change. But if it goes blue, it's gridlock, right? So there's a lot of uncertainty yet based on who's going to be writing our new fiscal policy. There's been this balance that's been created, but investors already know that we might, even as soon as December, not see any more rate drops, and we probably maybe will start to see rate hikes. The majority right now still says about 2-to-1 that there'll be a rate drop in December and that will hold in January. But everything's up in the air. It's a whole new thing.
Yeah, I'm looking at the House numbers, and the Republicans are up by 11 in the House right now. And so it could be red in all three departments, which is interesting with some of the policy discussions. And I don't know if you had a chance to catch the Fed or the Fed chairman's Q&A after his, but there's some tension, right? There's some tension between the president and the Fed, and his removal, his replacement, his impact on the policy, which is very interesting to see, which I think may have some effect in the things that you were just discussing.
Yeah, I mean, the Fed has had this mandate, number one, to get us to stasis, and number two, to get these IOUs off of the books, right? We started over 9 trillion. We're down to 7 trillion. So we've taken more than half of what they expected to take off. There's still another 2 trillion to burn through. And last time the Republicans were in charge, and the Republicans are often in charge of, the fiscal policy that comes out of the House of Representatives. And the last time that was happening was in the Obama era. And when the Obama era was pushing to get the Fed to cancel out some of these IOUs, there was a huge uproar in fiscal policy. I'm not sure if folks know that, but if you look back at history, I can show you even here, you can see it in this pictorial form. So right here, you can see this little moment here where there was an attempt, and there was a second one, an attempt at getting some of these IOUs off the books. And at that point, if you remember, it was called the Tea Party. The Tea Party had a huge influence in creating fiscal policy during those years. And they were like, no, don't start selling back bonds. Just hold your debt. And that's what wound up happening. And so you see this one was happening just because a lot of those bonds were expiring. They were 10-year bonds, and it was around 2018. And I don't know if you guys remember, but Trump had an influence on Jerome Powell for a little bit there, and he actually got them to start doing quantitative easing again. And it was all this behind the scenes stuff, and there was all these things being written up on CNBC and all the different Bloomberg and stuff about why is the Fed buying bonds now when they should continue to let them expire or even sell them. And then, of course, COVID happened, and so the Fed had to intercede there. But there was this weird, and it's shown right here, this weird moment where the Fed was like just creating cash. So it could be anything, but I think that, the policies are making investors, investors right now like the idea of low taxes for companies, right? They like the idea of low taxes for job creators. So, initially a big bump in the market, but a lot of these folks, if God forbid these tariffs go down, tariffs would be a bad thing, right? Every business owner knows that, right? Tariffs would be a bad thing. If some of these policies that Trump was talking about actually happen, then we'll see inflation rise again, and we'll probably see some interesting. So the Fed really did but the Fed was on a long-term travel here, but the Fed was basically reloading their tools for the next global issue that comes up. So the Fed was quite happy with the process they were on. They were happy with the current fiscal policy, which was, kind of redistributing wealth. And so there's a little bit of a tension because the Fed was like, we're on the right process. Don't mess this up with your fiscal policy.
I almost feel like this time around with Trump is going to be a little bit better because it's like, oh, he already knows kind of how things work, and maybe he's not as defensive as he was the first time, because it seemed like he was fighting off a lot of, illegal votes in Russia and this and that. And so now it's like, it's very evident that the people want him in office, and they kind of support his policies. And so, for me, I am most excited about this government efficiency council that I keep hearing from Elon and some of the other ones, because I do think that might have an impact on some of the inflationary pressures that we see just from government spending in general.
Yeah. I mean, here's the scoop. I mean, the working class people were not feeling like they got the problems in their life solved by government. I mean, and they were tired of being called, garbage. So they went to the polls and they said, this guy's not calling us garbage. He's embracing us, and he's talking about ways to deal with our individual problems. And so they voted him in. But I have to be completely honest, Sip, the first, and I hope we'll see about his learning curve. But, when he took office in 2016, he had the House and the Senate, and zero got accomplished that 2 years. So I almost feel like they're giving him a very short leash. And unless he changes the rules, which, that could be on the table, and, third term and all these things, these election rules. But unless he changes the rules, if he doesn't deliver on these promises in these first 2 years, I think in 2 years, the voters are very fickle. If he doesn't deliver, I think that you'll see, the Congress flip again. We'll see. It's all about putting, you've said a lot of stuff on the campaign trail that got people to elect you. So now you have to deliver.
Yeah. Tariffs, deportation, all sorts of things like that.
Both of those things would ruin the U.S. economy.
I do want to bring up the S&P real quick, so that we can kind of maybe take a look at these highs and do some of your retracement analysis.
Yeah, so let's get technical. Yeah, let's get technical. So, based on not even the pop on Wednesday, but we got a confirmation to our bottom being found. We had that confirmation on Tuesday. So by the end of day close on Tuesday, we had confirmed that on October 31st, we were at our bottom. So great. We solidified that line. We started this new line, and it's actually falling, as we have this uptrend. And it's not an aggressive uptrend like we saw a few months ago, but it is an uptrend, and it's matured, right? For us, from a technical standpoint, the way that we define a mature trend is having more than 2 tests. That's not bright enough. Let's make it really bright and really big. More than 2 tests of support and 2 tests of resistance. And so this has, another way we can tell that we've got a mature trend is when we have our best fit trend line. As we draw it or extend it, as we include each new day, it doesn't change very much. And that's a sign of maturity in the trend. And so, we're coming up to our level of resistance. So not only does it seem like folks, especially the market movers, again, I keep bringing up the pension, mutual, and hedge fund traders, not only do they seem like they're selling off, which we're seeing in order flow data, we're also seeing that technically we're up against this ascending line of resistance. So we expect a pullback probably down to this 5,800 level, maybe as early as next week when the stochastic shock kind of plays through. But yeah, this drawing is coming out just as we expected. It means that the market is more predictable as we move forward. And the last thing I have to do for you is bring up my rulers. So when we pulled back right to this level. If I was a swing trader right now, I would be looking for a bunch of swing trades. And right now, I'd be looking for how to either exit from those swing trades or how to collar. Now's the time to be collaring those swing trades. That's where you sell some premium and then you take that money and you put it towards a protective option. And that lets you stay in the long-term uptrend, but make a little bit of money on any pullbacks. So I'm expecting a short duration pullback as early as next week. And as we look here, I actually, I'm looking over here. We've already shot through. I mean, this is clear uptrend, ideal uptrend patterning here. So, I think we're at the top of our channel. Unless something happens after the next reversal down and we crash probably down to this 5,400. If we crash down to 5,400, then I'm going to basically change my whole bias and say, hey, we've got a trend reversal on our hands. But if we just pull back to that 5,800 zone, I mean, uptrend it is, at least in the next medium duration.
Yeah. And you've got your indicator there that gave us a little green arrow to the upside.
Yep.
And
here, let me zoom in for you. I'll get rid of some of this chicken scratch that I put on the screen. Yeah, we got our green arrow. This is from our indicator suite. This is the moving average. It's called the confirming indicator. This is one of our free indicators that you can go download. Actually, I want to tweak it a little bit. I see that I've got it set. We were talking about in my program some swing trading stuff. So let me just tweak it. For those of you that are looking at the broad market, what I like to do is use this confirming MA one. And this is how I set it. My fast length I set as a 3. My average type I set as exponential. My slow length I set as 5. And my average type is exponential. So by default, this is how the indicator gets set. I had tweaked it a little bit because we were doing some swing trading off of that same template. The template's very versatile. But yeah, you can see my green arrow and you can see my confirmation and you can see we're moving up. So it's pretty clear.
And looking at this most recent pop, I mean, we're only looks like 4 points off of that 6,000 mark, but that's gonna set us up for a very good year to date. And maybe we're a little too early to start talking about the year to date. We'll probably cover that in December. But if we pull back, I mean, that's like almost a 20% move in the overall market year to date, and that would sound pretty darn good in terms of holistic pictures of what's going on in the economy. So looks like things are heading in the right direction. The one thing that I do think is good to bring up is now that we are at these highs, how do we protect ourselves? And I think this goes into the premium selling and some of your option strategies where we are at these highs, where we could potentially pull back. Why not sell some premium, collect some income, and protect yourself? Which we'll go over a couple examples later on.
You betcha. That's exactly what people need to be doing today, Monday, Tuesday. That's exactly I couldn't say better myself. I'm looking at the year. Each one of these bars represents a month. So this is November. This month, this bar over here was October. I know I've got a lot of my drawings in there. Let's see if I can. Am I on my? Let me go to default. There we go. So November, October, September, August, July, June. What do we got here? May, April, March, February, June, January. So from here up, yeah, that's a good year to date, man.
It's showing me 24.6% is kind of the number that I'm getting, which for a year to date is probably more on the impressive side when we look at all the years of data that we have.
Yeah.
But as options traders, we want to protect ourselves, so we are going to go over a couple examples. But for now, let's take a break.
Sure.
Grab something to drink. We'll be back. We'll go over AJ's pick of the week. And then we did have a potential earnings play, right?
Yeah.
That we discussed last week that we'll go over. So sit tight, folks. As always, we are streaming live. So if anybody has a question or a name that you want AJ to follow up with, feel free to throw it in the chat. Otherwise, sit tight, and we'll be back in a jiffy.
You're afraid of trading in the markets. Guess what? I've got your answer. I've got 4 strategies I'm going to give you along with the tools to make it super easy. I'm going right home, giving you the webinar. I need you to sign up below and meet me in a few minutes.
So I tell you what, this week has kind of, concerned me a bit. One, a lot of people were upset that Donald Trump won. I don't know if you saw any of the videos, but people are like in their cars and they're screaming and
I know,
crying and this and that.
Well, thanks to you, I have been looking at TikTok. You guys out there, Sip helps me not just as being a host of this show, but he helps me, stay connected with all of you through different mechanisms. And he has me, engaging in TikTok, watching that. And my gosh, Sip, those videos seem like it's the end of the world. Some people are very angry.
Yeah, and I almost, I wish I could get a message to Donnie and be like, look, Donald J. Trump, you are victorious. Maybe it's time to pull back on some of the hate message and start to bring the United States of America together, because it's becoming very racial. It's becoming very sexist. Women versus males, Hispanics versus whites, But look, he's in office now, and I wish he would just kind of start to, just a little bit, just start to bring people together, because that's what America is at the end of the day. And if he did that and we continue to see these markets go up, people should benefit from it.
That would be the Goldilocks scenario, wouldn't it?
Yeah. All right, cool. So let's go over the trade from last week, right? It's interesting because I actually saw the Lyft CEO on Bloomberg this week. So they must have had their earnings this week, but Kathy from Reno set us up with a potential calendar. Is that right? A calendar spread for
and so let me refresh for everybody about these calendar spreads. So first of all, I got to give you a couple of reminders of how options work. When you look at an option price, right, it goes up and down just like a stock price. When you dissect that mathematically, there's 2 components in that price that add together. One is the real value of the option at expiration. And that's only in the case that the option is currently in the money, right? Because if it's at the money or out of the money, there's no real value. If it was to expire today, it would be worth zilch, right? So there's a real value component that only affects in the money options. And then there's this emotional component, right? It's called the extrinsic value or premium or time value. It's got a whole bunch of different names. And the real value, intrinsic value, sometimes they call that the in the money value. So when you create one of these calendar spreads by buying a, farther out in time option, an option that's not going to expire for weeks, if not months from now, and then you sell one that's going to expire, in the next 1 to 3 weeks, what you're doing is canceling out that in the money value, that real value, because you're buying it and then you're selling it, right? The real value of these two options, if they have the same strike price, is the same. It's just that the real value of this one won't be realized until a later date than this one. But the real value at today's date is the same. So when you buy one and sell one, that cancels out. And so all you're left with is this emotional component, right? Of this back month, where the emotional component of those options that are farther out in time tends to be more stable. People don't use those options necessarily for hedging something that's coming up around the corner schedule wise, right? They use the ones that are close to expiration because they're cheap, right? So you have this stable emotional one that you bought, and then you have this very volatile one that you sell, right? So if the volatile one is at a high price and you sell it, and then you come back when it comes low, you actually are selling to open, buying to close. And so you're selling at a high price, buying it back at a low price, and you make that spread while this back month option emotionally kind of stays at the same price. So that's the whole theory behind the calendar spread. But that emotional component also, besides being very reactive to this, driving up of price because people want it, and then, crushing in price because people don't want it anymore. People who use it as a temporary risk hedge, they'll cause that price to change. So these calendar spreads are very reactive to that. So we use them when we know people are worried about an event coming, and then we know that as soon as the event passes, they're not worried anymore. So they use these temporary options as temporary hedges against risk. So we take advantage of that with a calendar spread. But the emotional component is very extreme when the option is close to being at the money. So wherever the stock price is, we tend to go with options that are at that strike price that is very close to the currently traded price. If something happens with the stock price that moves it away from that strike price, then that could overshadow or, balance out this effect of the emotional component going up and down. So when we research these stocks, we tend to look for the ones that have gone through earnings seasons with very little price change, so that we can, take advantage of that huge, up and down of emotional instability. People buying these options as temporary risk hedges, driving the price up, and then once the event passes, selling them because they don't need those hedges anymore. So, take a look at 3 weeks ago, we looked at 3M. And if you look at the earnings, there was, a little bit of price action, but it wasn't too much. It wound up going from, 135 down to 125, and now it's back up to 135, right? So there was very little, extreme price action. Then last week, we did a trade on Xerox, XRX. And if you look, there was actually, a little bit more of a big jump in price, and it hasn't yet come back up, and it may not come back. We don't know how the investors did the earnings, and we still were able to squeak out an 8% profit on that emotional move, but a lot of the potential on that emotional move on Xerox was, canceled out by the change in the stock price. Whereas in 3M, if you remember, and I actually have all of these stocks up in a spreadsheet. I can show you that in a second. But in 3M, because there was very little price move, we got all that emotional change in our trade, and we actually doubled our money in less than 12 hours. It was quite extreme and quite awesome. Let me just open this file here in this other window. So now bring us to this trade that we brought on Lyft. We had looked at Lyft. We looked at what happened at prior earnings. I'm looking at 6 months, but if I go back, even a couple years and look at the last 4 earnings, I'll zoom in here and I'll even turn off some of my free indicators just so you see price. I don't actually want to delete them the way I just did. I rather just make them not visible. Let's try that. Click OK and click OK. There we go. So you can see some of the earnings caused a pop, but most of the earnings, there was very little price action from the day before to the day after. But here we were. We did that trade, and that was thanks to, I'm trying to remember her name, Kathy from Reno, Nevada. I think you said that earlier. So we went ahead and did this trade, and I'm not sure if Lyft had, we strictly traded it on this process. I didn't even pay attention to the earnings. Here's the results. I'm going to bring it up here as soon as I click this button. Yep. I'm bringing this spreadsheet in front of you guys so you can see. This was 3M. Remember I said we doubled our money. In reality, we made 101.08. So that's basically doubling your money. Xerox, we made 8.7% ROI on that trade. Not stellar, but I mean, for an overnight trade, not bad, even though when you look at the actual numbers, a lot of it got eaten up on our commission. I think we actually walked away after we paid our commissions of around, I think it was 4.5%. And Lyft, well, without commissions, these are numbers without commissions. We bought the thing for 54 cents, and then we were only able to get out at 55 cents. You can see we bought the thing almost at 3 o'clock the afternoon, the day before earnings, and we sold it right after the market opened, about 10:03 a.m. Here's what the price was trading at: 14.37 the day before, 18.47 when we actually got out of the trade. And so, you can kind of see what actually happened here: 1.85%. Xerox, just as a reference, it went from $8, or no, it went from $10.42 down to $8. So there's that case. And then 3M, there was hardly any change at all. We went from 134.40 to 134.54. One went down $3, but when you're talking about something that costs $134, $3 is a drop in a barrel. So that's why you can see that this particular stock, this particular trade kicked butt, whereas some of these trades, we were able to get out at break even, or a little better than break even.
And is the conventional wisdom that this strategy is more profitable when we don't have the move like we see in Lyft, where it pops and it stays at those levels, right?
Yeah, that's the wisdom. And to be honest, a lot of symbols, that's what they do. So one of the things that this strategy is good for is if you do it a lot during earnings season, because, most symbols, now we just happened to pick 3 based on our users. We had Xerox, we had 3M, and now we had Lyft. 2 of the 3 had a big move the next day. And so that works against us with the calendar spread. In fact, there is an option strategy that would actually profit on that exact scenario. That would be called a strangle or a straddle or a hybrid of those 2 trades. Those do that. So a lot of times, and I don't know if you remember, we had Mr. Passarelli, Dan Passarelli, as one of our guests. He actually, when you delve into his program, and I don't mean to, I get nothing from promoting his program, but when you go, if you sit through his program, he helps you determine whether to do, he's got more quantitative, besides just throwing these against the wall like spaghetti and hoping to see that they work out in your benefit. He has a, good thought process to help you decide, do I do the calendar spread, which in his statistics, about 75 to 80% of the time, you would do the calendar spread, but about 20 to 25% of the time, you would instead use a spread. So he has this thought process to help you not a spread. I'm sorry, straddle strangle, or hybrid of the straddle strangle. So he has this thought process that lets you through those two. But yeah, we're just seeing 3 random examples. If you really wanted to do this, you'd do it all through earnings season, and you'd probably follow a more detailed process like Dan's got that would help you, decide, do I do the straddle strangle or do I do the calendar spread? We've just been doing the calendar spread as kind of a test as to the calendar spread's work. And I actually think if you really wanted to simplify things, and you had like 20 of these trades and you just did calendar spreads and you used the automated bots that I've been using, I wouldn't be surprised if, like his numbers say, 3/4 of them wind up being hugely profitable trades and 1/4 of them wind up breaking even or coming out like that.
And for anybody that may want to check that episode with Dan, that's episode 153. So four episodes ago, Dan came on and gave us a little bit of insight on that.
In fact, I see a chat where somebody traded Lyft and it says, this is Doug. He said he grabbed an overnight profit of 14% and never looked back. It would be interesting to know what kind of trade Doug did in order to get that 14% profit, whether he traded the stock and just traded it directionally, if he used a straddle strangle, if he used a calendar spread. That would be interesting to get some information. Doug, if you're listening, you may want to chat that part B of your message to us. That would be cool. If you don't want to divulge that information on a live show like this, that's cool too.
And that's the beauty of investing in the modern age, is the variety of ways to get into position, either straddles, calendars. We even had our guest last week that has an earnings or a futures component to earnings. So a lot of different ways. On this show, we like to focus on some of the more of the options, positions, and strategies. So Kathy, once again, thank you for bringing Lyft to the table for us.
Look, Doug gave us a part B. Do you mind if I compare and contrast really quick? I know we're running low on.
I'll pull it on the. There it is. I put it up on the screen so that people can see.
Awesome. So the scoop is you can see here we used a November 15 and a January 17 option. Doug says he used the November and he used the June option. So an even more stable back month option. And so, yeah, Doug was able to do the calendar spread. He pulled out 14%. And, for a trade that happens overnight, yoo-hoo, and so that also brings us, we're talking about these different strategies, but there's also just the option itself. People don't understand this. I was talking to somebody who randomly called me on Sunday night, right? This was one of our people who have been receiving my emails, and he wanted to talk to me about some trading. And he said, listen, my big thing is to trade the stock direction with an option. And I was asking him, I'm like, well, which options do you choose? Because what we're pointing out with Doug's calendar spread versus the one that we did is options themselves, based on their expiration date and their strike price, can behave completely different from another option. Not all calls and not all puts are the same, right? And so, that's the beauty of using options, is you can really tune, like Doug tuned his strategy even better than I tuned mine. I got out basically at break even. He got out at 14% by, really stabilizing that back month option. So kudos to you, Doug. And it just shows also that you could use this calendar spread even, even as a standardized trade through these earnings, even where maybe a straddle strangle would be better, the calendar spread could still be used, and different types of gains or losses depending on the options you choose to populate that thing. And that's why people come to hang out with us here at Trading Trainer, is to learn those nuances. So, hey, welcome to all.
Yeah, and just so everybody knows, AJ, you and the crew aren't so gung ho on these earnings. It just happens to be earnings season, and these opportunities are presenting themselves. So we're reviewing them. But once earnings season is over,
Premium selling.
There's a slew of other approaches, right?
You betcha. You betcha. I mean, I'm pro making investors money, and during earnings season, this is what works, right? These are predictable patterns. People will hedge their investments with short duration options right before earnings, and then they'll remove those hedges right after. No matter whether the stock pops up or down, that's beside the point. This is a pattern that we can trade for profit. So my big thing is determine what the predictable patterns are, trade them for profits, rinse and repeat.
And with that, we can dig into your pick of the week.
Yeah, let's do it.
One of the trends that we're seeing with these markets hitting these all-time highs is commodity prices, specifically gold, have been at these elevated levels. And a popular name that the people like to use on equities to kind of follow the price of gold is your pick of the week, Eldorado Gold, ticker symbol EGO. So what are you seeing in that, and why do you like it?
I want to trade Eldorado Gold as one of my premium trades. So they already reported their earnings. They're in and out, and they were one of the stocks, by the way, that earnings didn't really change its stock price very much. But I'm seeing support at $16 SIP. I'm seeing resistance at $18.25. Let me put one of my indicators on. I'm going to use this confirming indicator MACD, and I want to show everybody how I like to set it up. I like to set it up on volume weighted average price, and that's very unique. And that's why you should go download this free indicator if you haven't already, because it gives you the option in the MACD calculation to choose different types of seed prices. And I'm a big fan of choosing the volume weighted average price. Also, I've set up this MACD and in this indicator to be what we call the fast MACD settings. And just to review those, 6 for the fast length, exponential type, 19 for the slow length, exponential type, 3 for the average length, exponential type. So you plug that into your indicator you've downloaded, and you make sure you turn that thing on. So let me go ahead and turn it on so people can see the arrows. There we go. And so you can see we got this beautiful top signal with follow through. And so that would have been a great top, but we haven't yet got our bottom signal. But when we do get that bottom signal, I'm talking about buying the stock, or if you use, again, get yourself access to our web portal. That's where you download those free indicators, but also you can see the new options lookup tool that we've been talking about. You can get kind of a demo of it. And so if we put in our Eldorado Gold, and I'm going to set my strikes to all, because I'm going to find a good substitute. And one of the things that one of the things, and you can see I didn't in that write-up that you just posted, I still have some of my past notes. I forgot to update them. But that's no problem. We're going to do it live right now. So when you want to find a good substitute for doing a long, not a long term, but a medium to long term, one of the things we do is we go about 8 months out in time. So I'm going to look at these April options, and then we're thinking about substituting it in the bullish direction. So we're looking for a call, and basically you're going to go deep enough in the money that the extrinsic value is around 5%. And we want to make sure that the bid-ask spread is tight. So you can see here, this one at 5%, that bid-ask spread is too far apart. I mean, $3.20 all the way up to $6.80. That's too far apart. That means that there's not enough liquidity. So we start to compromise, right? Now you get to the next one at the $13 strike price. Yeah, it's higher in its extrinsic value. In fact, it's considerably higher. It's about 3 times higher at 15%. But now you can see that the bid-ask spread is really close, $4.34. That means that there's people trading it, and that's what you want. So I would say instead of buying Ego stock, but it's at a good price, you could buy the stock, but you could also, instead of buying the stock, which is trading around $16.75 right now, you could also buy this $13 call and get it for about a third of the price, right? That thing's only going for even a fourth of the price, $4.40. You'd have some leverage in there. It would be cheaper to get in, and then you'd be set, right? So the idea here is buy it low, whether you buy, EGO stock or you buy that, what expiration date did I say? I said the April option. You buy that April $13 call, and then you allow that thing to appreciate. And then once it tops, like it did a few weeks ago, that's when you sell your premium, buy your protection, and you wind up creating this income trade out of it. And I love those trades that are going to be giving me income month in and month out. Double-digit incomes, 10, 15%. I wouldn't doubt that this stock could produce that for us.
And that's AJ's pick of the week, Eldorado Gold, ticker symbol EGO. I do have a question, AJ. When does earnings end? When does the earnings see? What does that look like on the horizon?
I think most of the stocks will have reported by this week. I think there's a few laggards that'll be next week, but we're pretty much winding down now here in the beginning of November.
So we'll probably be discussing more of the premium selling positions rather than some of these earnings call. But, it is seasonal, and that's how we do things around here. Wherever we see opportunity, we'll review it.
Put Eldorado Gold on your radars, everyone.
For sure. I think we have time for maybe one more name before we close the show out, and sure. I'm going to go with Frank in Oklahoma City, Oklahoma, with Ross Stores, ticker symbol ROST, popular retailer.
Yeah, I love trading Ross Stores. Now this stock is a little bit more expensive, but I see what you're talking about here. You've got a clear tested level of support around $140, and maybe a clear level of resistance at 155. So traditionally, what we do here at Trading Trainer is we either buy the stock or we buy the substitute option, and then we do collar trades throughout the life cycle of either owning or shorting that stock or having the substitute option. This is kind of expensive. Now, if you have a big portfolio, and I'm guessing you probably have a portfolio north of $75,000, then you could do that strategy here. But another thing that you might consider, and I see that we got a signal, and we might have gotten follow through either yesterday. If not yesterday, we're getting the follow through today. You might consider a legging into a condor. So what does that mean? That means once we get confident and believable confirmation that we're heading up, I would do a vertical spread. Now, here's the thing, right? People have totally screwed themselves by using vertical spreads incorrectly. And I don't care whether you use a credit spread or a debit spread. That's up to you because they're synthetically equivalent. But the thing about vertical spreads is you have to understand that they very quickly go from a profiting to a 100% losing position very quickly. And people don't often calculate that. I would say that when it comes to options, the number of courses out there on buying vertical spreads is way more than any course on calendar spreads, diagonal spreads, what we do, premium selling. Vertical spreads is a very popular topic. But then again, I'll also say, Sip, of all the courses I've looked at on vertical spreads, very few of those courses do position sizing right. And what everybody who's watching this show or watching the replay needs to understand is that a vertical spread has 100% risk. No matter how you model it, it's 100% risk. That means don't put it's so easy because they're so inexpensive to put a lot of your portfolio into it. Don't put any more money into the trade than you're willing to lose. So if you're only willing to, risk 1 or 2% of your portfolio, then whatever your portfolio is worth, if it's $30,000, that would be, $300, right? If it's $300,000, that would be $3,000. 1 or 2%. Figure out what that number is and don't invest any more into this trade than what that number is. And that way you will protect yourself. So putting a vertical spread on here, this would be called a bull vertical spread. I would do that. And then as I get close to the top, if I get my top signal, I would go ahead and put my bear vertical spread on, and I would just cycle between those two. And every time I put the opposite vertical spread on, I would evaluate the number of days to expiration, and I would either leave the previous spread on or I'd close it. I'd make that determination every time there's a reversal in the sideways channel. But basically you're legging in and out of a condor, and you can do that. Just don't overextend yourself. I've had people come to me crying who have taken one of these vertical spread courses and they've wiped out their portfolio using vertical spread. So be very careful around risk. But yeah, that's what I would do here with Ross Stores.
It's kind of surprising that the discount retailer is trading at such a high price, but I guess it all comes down to, valuations and stuff. But you're right. That is kind of on the higher end, and you definitely need the portfolio to get into Ross. So thank you for that, Frank from Oklahoma. Okay, AJ, heading into the end of the show. It's been a wild week. Things are starting to settle down, at least from a national perspective, I suppose. What do you want to leave the audience with heading into the weekend, heading into next week, heading into the middle of November?
I mean, this is the week before the last week before our monthly options expire, right? So we need to start thinking about, if you guys are doing these vertical spreads, if you're doing your collars, and you're using the monthly options like I am, starting next week, we're going to change our attention from November 15th to, let's see when the December option expires. The December option is expiring on December 20th this year. So changing from November 15th, we're going to start looking at the December 20 option, and we're going to start thinking how we're going to capitalize. If there's any trades next week that we need to close, it's always better to close the trade. If we're at all skeptical about whether it'll get exercised or not, let's just close it on Wednesday or Thursday of next week. So we're starting that process. We're back into our everyday, process here. If we're doing premium trades, we need to think about, closing down our near-term options next week. We need to be in that mode. And, whatever you felt about the election, elation or, disappointment, like Sip and I saw on TikTok and other types of social medias, wherever you are, I urge you to just, be optimistic. Your investing. Let's get back into the process. Let's get back focused. Think about yourself, take care of yourself, and just what we always do, we trade it as it comes. And so our beautiful part about trading options is we can trade whatever pattern appears and matures. So recognize the patterns, trade them. It's a process, and it's something that we just continue doing.
157 episodes consistently
under our belt.
If you are out
weird
there,
hand gesture.
Under the belt, yes.
Sorry, guys. I thought that was different. I was watching it in the camera, and I'm like, oh.
If you're new to the show, we do appreciate you tuning in. Feel free to show some love. Head on over to that AJ's Quick Links page. The link is in the chat. Get access to the Indicator Suite. Hit that subscribe button on our YouTube page. Hit some follow buttons on our TikTok, Instagram, and Facebook pages. There's a free daily workshop that'll break down some of the premium selling strategies in a more basic format if this is new to you. And in general, just feel free to show some love, because we do appreciate you tuning in. And AJ, I appreciate you hopping on today, getting some of your insights. And yeah, it looks like we're going to be closing the year out in positive fashion. So we'll tune in next week to see, if anything settles out, if the S&P crosses over the 6,000 mark, and what's ahead after that.
Yeah, don't forget, we're going into the holiday season, folks. And this is where, Black Friday, where traditionally retailers have been having a loss all year. Retailers are going to be, pushing. This could be a great holiday season, push that market even higher. 2025, we'll see how this plays out. But yeah, I'm quite excited for the rest of this year.
2025.
Can you believe that's right around the corner?
Say that, yeah. All right, AJ. Thank you again. Thank you, everybody, for tuning in. Feel free to smash that like, subscribe, follow button, and we will catch you all next week.
Bye.
For tuning into the AJ Brown Show. If you're interested in learning more about AJ and his investing techniques, head on over to tradingtrainer.com and create your free account today. And if you're not already a subscriber to the show,